But I think as we kind of look at, where are we and where were we and sort of what's the opportunity, people are going to look back, in my opinion, and they're going to say that the best deal that occurred on a bulk basis occurred in September of '09. This was a deal, I don't know if anyone knows Coors Bank. Coors Bank was one of the largest construction lenders down here and also in other hot markets like Las Vegas, San Diego, places like that. Coors Bank, right before they got shut down, they sold a note on a project called the Caribbean. The Caribbean is up on 38th and Collins Avenue. They sold that note, it's hard to pinpoint for sure, but I know the guys who bought it. These buyers came in at about $330 a foot. Let's just say that for conversation. And in order for them to do the deal, they had to go hard with 10% of the purchase price, which is roughly about 53 to 55 million. They had to go hard day one, meaning non-refundable. 3 days later, they closed. And the reason they closed in 3 days is they were afraid the FDIC was going to shut down this bank and they wouldn't be able to get the deal done before they could ultimately take it. Now, lo and behold, they ended up stealing the crown jewel out of the Starwood portfolio. Starwood thought that they were going to come in here, they were going to get this whole nice Coors portfolio. These guys out of New York came in here, they took it. They took it, they pumped some cash into it, they took it to market to second home buyers, to investors, to people from up north who want to have their dream residence out here. So they got in at $330 a foot, maybe they pump another $5 to $10 a foot into just sort of shoring up the product. They sell it raw. You walk in there, it's a beautiful smell of cement that you're not smelling too much anymore. They take it to market, they have about 5 units left out of about 90 to 95. They blended this thing out in less than a year at over $640 a foot to all cash buyers. Now what happened is all the institutional money that was running after this, they all said, well, what can we retrade this at? We told them $550 a foot, $600 a foot. We're very confident that we could get you out of that at that product, at that price. They didn't think it was possible. Every time they come down here, I'm making a point when we go to the W or we go to Prime 112 and pull out the spreadsheet and show them what this stuff sort of retraded at. So kind of the point of the story is this market is turning. There was a lot of pessimism about what was going to happen in South Florida, a lot of pessimism about what would happen in downtown. And really as it's turning, you're starting to see newly converted buyers who thought before that it was all going to go to hell and they were going to buy for less than $100 a foot. They're now starting to come to grips with what the real new pricing is. And effectively they're being forced to recalibrate. What I mean by that is the approach is based on buying in Miami. Miami's gone for the most part except for a couple trophies. The biggest deal in play right now is the Everglades on the Bay. 685 units. Bank of America's in for about $205 million. Thing will probably trade for about $150 million or so. Bank of America will take about a $50 million hit. Once that goes, that's like seeing the last of the woolly mammoth. You're not going to see something like that again because there's nothing with what the New Yorkers call tonnage. Tonnage is size, scale, something I can buy, I can retrade, and I can take some time to sort of move that product. So as that's going, we're being forced to go elsewhere. I've been spending more and more time in West Palm Beach. I live in Miami Beach. The reason I'm in West Palm Beach is that they have about 900 units unsold still up there out of about 5,000 that they built during the whole boom. Broward, nothing left. Unless you want to go west. You want to go into failed condo conversions built in the 70s, all day long. Take as much as you want. But unfortunately, everybody wants new because they don't think a crane's going to go in the sky to build any kind of condos relatively soon. Bankers tell me $525 a foot is what it'll have to average in order to justify new construction. So they could cover new construction and they could put the profit in there and start building some other things. So as we bring it full circle, we're standing here in Miami Beach. Somebody's looking for a second home buy. I would probably tell them, go to the west coast of Florida if they really want to steal, if they want to buy things at $35,000, $50,000, $100,000 a door. There's roughly about 40 units for sale in the city of Miami Beach proper today under $50,000. Most of those are going to be 1950s construction. There'll be condo conversions. There'll be various states, but they're definitely out there. No parking, but most people come to the realization that they want something better, and then you tend to upsell them. So it's not unheard of. They have somebody come in for 50 grand, and ultimately they end up spending $300,000 or $400,000 because they're simply not comfortable with what they have. As you go north, the prices go down. If you're looking strictly for numbers, West Palm Beach, I would tell you, is the best place to be right now. Palm Beach County, the inventory is growing. The foreclosures are still on the rise date. It's all slowing down. Quick fact before I end, about 250,000 foreclosure filings. This is the initial step before a property is repossessed. Right now it takes about 18 months for a bank to reclaim it. It's costing the bank about $100,000 out of pocket. That number is probably going to increase because of a recent condo law that changes how long the lack of maintenance period is. It used to be 6 months, now a bank has to settle up for 12 months. So of these 250,000 foreclosure filings January 7th, only 100,000 have been taken back, roughly about 40%. Now, some of them are duplicates because there's a first, there's a second, there's a condo association that's filing. But what I'm sort of saying is that, you know, there's still more pain to be felt, but I would tell you, and I would make an argument, most of the pain is going to be felt in what I call the hinterland. That's going to be out west, that's going to be down south. That's not the place that the investor who's coming from up north or is looking for a second home is going to be buying. That's more of the real people who are affected by unemployment rate, the people who are buying east of 95. You know, probably the best story I can tell you is we closed a deal in January of 09. Lehman Brothers went bad in September of 08. Everybody thought the world was ending. We closed a deal in Jay Beach. Gentleman paid, actually my wife Jenny is the one who did it. Gentleman paid, I think it was about $1.5 million for this unit, all cash. Afterwards we went to Carpaccio's over at Bell Harbor, stood in line to basically be seated. They spent $500 on dinner, and the only thing we discussed is how bad the economy was. So that's kind of the reality of South Florida. People want to be here, they want to buy here, there's opportunities here, but now if you want to get into South Florida, especially South Beach or increasingly the other side of the causeway down to Miami, you're going to be forced to pay. If they don't want to pay, they're being forced to go to the West Coast, or they're being forced to go to Broward and increasingly Palm Beach. And then after that, it'll really be the Treasure Coast, St. Lucie, Indian River, and Martin counties. So with that, I will finish up, and I'll turn it over to Bob, but I think Bob's going to be talking about the financing aspect.
Well, he killed my presentation. I just want to introduce Bob Vaughn. He's actually the last formal speaker this evening. He's the managing director of AmeriCorps Vacation Finance, which is a consumer mortgage and finance company.